The Business Innovation Zone, also known as the Biz, is the place to start for entrepreneurs in Iowa. The Biz helps entrepreneurs and startup companies focus on idea development, business models, strategy, market validation, mentoring, and networking. We also help clients connect with qualified community and state resources needed to grow their business. Throughout the year, we provide a number of networking opportunities with experienced entrepreneurs and business leaders by offering monthly luncheons and all-day seminars on marketing and finance. You can learn more about the Biz at bizci.org.
Good morning. As Mike said, I'm J.D. gesener. Oops, Mike, I already got his. I'm a senior partner with LWBJ Financial. Sorry about that. We have two divisions. We're a traditional CPA firm and then our Capital Advisors division, and that's where I spend all my time is on Capital Advisors. Capital Advisors is a registered, FINRA registered broker-dealer, so we're an investment banking firm and a consulting firm. So we raise capital for companies, do M&A-based transactions. We do just a great deal of business startups. I work with Mike a lot on a lot of his clients. I'm actually a mentor here at Startup City, although they're about ready to probably kick me off the island at some point because I don't spend enough time here. Business valuations, we have a growing business valuation practice. There's a lot of reasons to have a business valuation. Peter Bonstrom's one of our experts on that. He's going to talk a little bit more about that later this morning. Turnaround and restructuring services, and then just operational-based financial consulting. I'm going to walk through, you're going to hear a lot of redundancy today with regard to the types of investors. I'm going to begin this morning talking about the evolution of the company itself and the funding sources typically in that evolution. So we're going to go through maybe 6 or 7 stages of a company and then talk a little bit more specifically about the investors as well. So begin with an idea phase, and what that really is you have, you're going through some general ideas or theories of a business. Generally, you're either funding yourself or you're not really incorporating a lot of cost. You're just beginning the process. You might have already had a situation or a relationship with a customer where the customer says, hey, if you did this, I might fund a piece of this or something like that. Let's look into this. Usually self-funded or customer funded. The proof of concept phase is really initial research. You might commission a market feasibility study. You might start to explore possible distribution agreements. You might query customers. You're really trying to, if you will, get to a point of some type of validation that there is a business there. Generally, again, self-funded. Friends and family. Friends and family is, as Mike already talked about, it's Aunt Betty, or it's somebody down the street, or an acquaintance, or a college roommate, or something like that. And generally, what they're doing is they're investing in you. They trust you. An angel investor, we're going to talk a lot about today, but really that's a high net worth individual, and we'll define that throughout the day. If you're somewhat bankable, the Small Business Administration does have opportunities through banks where they'll do some guarantees of loans. And then the state of Iowa. And the reason I have debt written there right now is primarily what I'm speaking for there is the demonstration fund that Mike is very actively involved in. And generally that's structured now where you're going to pay that back over time. It's not generally now a grant. It's really a loan to you based upon future revenues or earnings that you're going to pay that back. Product development. You might be testing. You might be in the beta stage. You probably have had conversations with potential customers. You could have, possibly again an on-site implementation. Generally, you're going to see the same type of investors, angel, possibly the state of Iowa through IDID, the demonstration fund. The demonstration fund will provide funds for the development of product and/or research of product. Seed funds. Seed funds are generally funds that are specifically purposed. They're usually geographically tied. It could be a group of angels that put money together. It could be like the AIM Seed Fund that is basically a group of high net worth people that collect and meet and vet deals together. And then we get into regional venture capital firms. You're still kind of in the early stages, but regional venture capital are again usually geographically tied. They might be industry specific as well, but they're looking for early on opportunities to invest in companies that they can step in at a low valuation and help guide the company through its growth. And then SBA or bank debt, again, it's always an option, and it's obviously a non-dilutive option. And what I mean by that is if you're borrowing the money from the bank, you're not issuing shares in your company and you continue to have your ownership. So banking is always a viable option, although there's not a lot of banks out there that like to lend without a whole lot of guarantees. The expansion stage, you've got customers and they're actually paying you, and that's the biggest validation you're ever going to get. You might hear a lot today about external validation. That's just huge. I mean, in other words, the market has validated you in some capacity. In these types of situations, you still have the same type of investors, the state of Iowa angel seed funds. You might get into some national venture firms now and or private equity firms, investment banking firms. That's what my firm is as well. In other words, we actually are licensed to go out and raise capital for companies, but we have relationships with a lot of private equity. We have angel relationships as well. And so generally when you're out generating revenues or even somewhat at the early stage, you can get in with an investment banking firm and then back to, obviously, the bank as well. Then the growth stage, you're generating profits, you've got cash flows, you've got the opportunity to maybe you want to expand geographically, you want to increase your vertical integration, you want to increase your distribution. You still have all of those opportunities with regard to the investors, and then obviously your commercial banks as well. Types of investors. Who are they? Friends and family. Again, the profile is that you have a relationship with them. They know you from somebody, or they've been referred to you from somebody. Their investment criteria is generally more of a subjective criteria. They trust you, they like the idea, they like the concept, and valuation of the investment is generally more easily negotiated. Angel investors are high net worth individuals. You may hear today too accredited investor. An accredited investor is just an investor that meets certain SEC related guidelines. It means their net worth's over $1 million, have annual income of over $300,000 combined, or $200,000 individually. It means they have the capacity to invest in deals. They're usually looking for less than a majority position in your company, maybe 10 to 40% of your company. And the important thing on this is to realize that when you're in the early stages, you want to get strategic money as best you can. So there's a difference between just getting financial money. In other words, an angel investor may be able to bring specific information of the industry, distribution, relationships, etc. And so some may like to be passive, some may like to be active. We have a whole group of angel investors that actually like to be actively involved on the board or an advisor to the company as well. It's kind of their sandbox. It's what they enjoy doing. Some prefer to be very passive. The regional seed funds, again, are either tied, they could be an agriculturally based seed fund, a technology-based seed fund, an Iowa-based seed fund. Geographically and or into an industry, they've got a defined purpose. They're more sophisticated. They're going to want some type of preferences. And all that means is they want some further rights that maybe you don't have or your common shareholders don't have. And that could be that they get their money first out, that they might be able to get an additional return on their money. They can maybe have voting rights over board members. So they're going to usually demand some certain preferences. And again, they're usually in a minority position in your company, maybe 10 to 50% of your company. Then the nationals, so what Mike was talking about, the book, the Venture Deals book, they're very sophisticated. This is what they do, obviously, for a living. They're going to provide, they're going to have a board seat, operational oversight, very sophisticated. They're going to be preferences and rights, and sometimes they even, could take a controlling position in your company. I'm going to touch briefly on this as far as how some of the concepts of how you get capital. It needs to be a compelling idea, obviously, that meets a targeted need in a growing marketplace. Detailed business plan and or executive summary. Financial projections with realistic assumptions, and know your financial projections and understand your financial projections. And then it just is a lot of persistence. The most important thing on this slide is listen and learn from what you hear from the marketplace. I meet with a lot of individuals that have been out raising money 6 to 9 months, and they've been getting some constructive feedback, but they don't want to absorb that or understand that. It's really important to listen to what the investors are telling you, reasons why, what they like, what they don't like, structure, how the deal looks, a little bit maybe even about the company and the company's revenue model. Really listen to the marketplace. 6 fundamental criteria that must be addressed. in a business plan for any investment consideration, and then finally know your business plan. I'll run through these very briefly, but understanding the business concept. Is it sustainable? Who's your customer? What's your product? What are you selling? How are you selling it? Really understanding the business model and being able to articulate the business model. It's not, well, we could sell this, or if we do this, we might go that path, or we might go through distributors, we might go direct. Really knowing and understanding and being able to articulate what your business model is. How is it a differentiator? You know, we say preferably not a commodity, meaning a like service or product. But if it is, what differentiates it? Is it additional service? Is it knowledge? Is it expertise that the company brings to the table? What differentiates you in that marketplace? There we go again, outside validation. Do you have customers, testimonials, possibly strategic partners, which is, you know, other than customers, that's actually a very, very important validating point. You might have a distribution agreement. You might have a takeoff agreement where you already have customers in line. You might have been doing a beta with an option to buy. So there's a lot of things with regard to strategic partners are important. And then outside professional assessment. Do you have a patent? Do you have, has there been a manufacturing or a financial feasibility study done? A lot of times in banking relationships or SBA related relationships, or even in funding relationships, angel investors or regional seed funds will do due diligence, and it could be that somebody's done a prior due diligence on a first investment into you, and you can leverage that. They've actually validated some things, done some research, maybe background checks on you as well. Management team, most important piece in this is that I always use, they're investing in the jockey. They're investing in you and your ability to execute the business plan. You know, you want depth of experience, you want space knowledge. In other words, you understand the industry that you're in. You're incentivized to grow the company. But at the end of the day, it's really investing in the management team's ability. You could have the greatest opportunity, the greatest product in the greatest marketplace, but if you have an inept or inadequate management team, you've got challenges. Now, in a business plan or as you're sitting across the table from a potential investor, if you're identifying those gaps in management, that's important as well. You don't have to have it all in place, but you have to have them identified where your weaknesses are, where your strengths are, and how that's going to get complemented. Predictable business model. Can it grow to cash flow? Is there a large market there? And have you been able to articulate that? And then vertical integration and or other opportunities with regard to the business model itself. And then finally, you know, at the end of the day, they want their money back with you know, a fairly high rate of return. So how do they get their money back? And there's a lot of ways that it doesn't have to necessarily be clearly defined. But if you have the opportunity in the marketplace where there's competitors, or you have the ability to sell or merge, possibly it's acquisitions, add on equity. A lot of times that occurs where a company gets to a certain point and a private equity will come in and buy some ownership of the company to pool them with other companies, et cetera. A put option is a situation where, particularly at the angel investor level, they might come in and say, you know, I'm going to invest in you, but I tell you what, I want the option. I'm going to put $200,000 in, but I want the option at the end of 3 years, 5 years, that I want $300,000 back, and I want to be able to put those shares back to you at the end of 3 years if the company can sustain that. That's just a put option. A lot of times you'll see that, particularly in the angel stage. And then the nicest piece is just through distributions and dividends of the company that the investor sees nice returns. So it's cash flow from the business that they say, hey, if I put this money in, I can see where I can actually get cash flow back and then ultimately get an exit on the sale of the company, but I can get most of my return back from just the cash flow of the business.
Excuse me.
Absolutely.
Could you expand a little bit about what you mean by high return? That's kind of nebulous.
Most venture funds are 25+% return, annualized based return. Angels are a little more subjective, but they want a higher return than they could get in the stock market, although that hasn't performed much lately as well. But it's risk capital we're talking about, so they want to understand how they can, you know, get a fairly decent return. Angels and friends and family will come in and maybe not necessarily dictate that return. One of the things we do when we put a term sheet together, we come up with what is an IRR. It's called an IRR. It's internal rate of return calculation. And it's really based upon assumptions either the business is putting off cash flow or the put option that gets executed in 3 years and or the exit strategies of maybe selling the business in 5 years. So the internal rate of return generally should be around 20+%. They're not unless it's Aunt Betty, they're not investing necessarily because they like you. I mean, they want their money back and they want to make money off of you. So that's just the important thing to make sure. Again, equity capital now. You know, again, it's money invested for a return. It's ownership, and it's permanent. A couple of things to think about what this means is, you know, you now have a partner in your business. You're giving up some ownership in future profits, but you're funding to expand, thus increasing the value of your business. So if you never took the capital and 100% is zero, is still zero. So the point being is it's money used to grow the value of your business. You've got, you know, possible management assistants, new bosses you've got to report to possibly. Depends on the type of investor, but the structure's changed now that you've got other people in there that want to understand what you're doing and the performance of the company. Again, performance expected with return, and it's possible. We'll talk a little bit about this of oversight, board of directors, steering committee, et cetera, that that might want to meet monthly or quarterly just to understand the strategic plans and then the overall performance of the company. Some added risk is obviously you're losing a little bit of control and dilution. All dilution is you're giving up a proportion of your company. And then finally, just an important thing. Organizational structures, the owners of the business really run the business, and I assume you probably all know this. Then they elect a board of directors, and sometimes there's an advisory committee and then management. But the point is, investors really dictate and can drive the organizational structure of the company. That's a real quick overview. I'd be glad to answer any questions. A lot of this you're going to get in further detail today. Yeah.
There are a lot of chicken and eggs scenarios here, it seems to me, but let's say you have a business that is going to take a significant investment in something up front. Say it was a website that may cost, you know, tens of thousands of dollars. At what point do these various investors want to actually see something rather than just hear an idea and say, you know, come back to me when you've beta tested this thing and you've got it out there and you're ready to roll it out big time, as opposed to, I want to hear your idea and maybe I'll like it.
Right. You know, the simple answer is they want as much validation as they can, but a lot of times, and I have a lot of meetings just like that, hey, I've got a great concept, it's going to take me X even to get to a certain point. It's finding the right investor that understands the industry and the opportunity as well, so that, you know, companies can get funded from the idea phase, but it's certainly more challenging if it's just an idea or a concept. It's knocking on a lot of doors, to be very frank with you. If you have the ability to have done any research or any type of customer profiling and be able to understand the marketplace and be able to articulate the marketplace opportunity. The challenge there too is if it's a sophisticated enough angel investor and it's somebody that you don't have a relationship with and you're that early stage, you're going to give up a lot of your company on valuation. I mean, they're taking, you know, significant risks with you because there's really no validating point in the business yet. And it can be done, but it's a challenge. Yeah.
So when you were discussing the different types of structuring of investment, you're talking about the difference like with the put option or a share of dividends and plus an equity stake. First question, when someone's getting dividends and equity, does that reduce their equity stake because they're getting it offset somehow with the dividends, so the requirement isn't quite as high?
It can be, but generally what can happen as well is generally a dividend and or a distribution is just a proportional distribution of your ownership. So short answer, no. I mean, if somebody puts $200,000 in and gets 200 shares and they own 20% of the company and you issue dividends, they're going to get 20% of those dividends and or distribution. So normally what can happen though, and there's so many, there are so many creative ways deals get structured. It could be that they invest $200,000, but they get an 8% return. That you're paying a coupon rate or an interest rate to them. They still have the equity, and there may be a way to negotiate that a little bit, where you're saying, I'll tell you what, for this $200,000, I'll only give you 15%, but I'll pay you 8% interest on a coupon rate or something like that. But generally, a dividend or a distribution is just proportionate distribution of earnings. So not typically adjusted for any valuation, but you know, there's other ways it could be structured where they might, if they want the first money out, they want certain preferences. In other words, if you sell the business tomorrow once they've invested, and you sell it below a certain level or something like that, or below a value that they came in at, there may be ways that they can structure it where they still get a preferred return or something like that. So they might give up stuff on or some value on the front end for whatever their protections might be on the back end, if that makes sense.
The put option. So someone has $200,000 they're investing in your business. Could you drill down a little bit on that and how that structure might look like?
Yeah, we just did one of these last year, and what it was a spin out of a company from a corporation, and so basically the nice thing about this is the owner didn't have to put any money in. He was spinning it out, but the owner of the company at the time that spun it out, they wanted the right to be able to sell. They had a 20% interest in the company. 5 years from now, they set a value which had some return, not significant, but a nice return, that they want to be able to put those shares back to the company for that value. And it needs to be written into the company. It doesn't, bankrupt the company. The company has to be solvent enough to do it. There's ways to structure that put option where it could be paid over time. But what it's doing is it's giving a window for an investor to see, hey, if things are really going well, I have the opportunity to get out at a certain point, and I know already what that value is at a certain point. And this particular situation, they had 30 days to exercise that upon a date. So it was 2015 or whatever, they had 30 days to notify the company that they're going to exercise that put option, and then the company would have to buy those shares out if there was requirements for solvency with the company and everything. But it sometimes is a way that gives the investor a little bit more comfort. The other thing that can be done is an investor can loan you money. An angel investor can loan money, $200,000, loan you $200,000, and it's just an obligation that you're gonna pay them over a 3-year period or something like that. But for that, they want 5% of your company. So it's still kind of a structure where they know they're going to, as long as you can sustain cash flow, they're going to get the money back. They're $200,000, and they still own 5% of the company. I see that a lot of times on angels as well, where they'd rather have it structured as debt to you, but they still, for issuing you that debt, they want you to give up a little bit of your company as well.
And you're giving up a smaller percentage of the company because it's
right. Right. But the onerous part of that is the fact that you're a startup and you have to pay them the $200,000 back.
And that payment could be that option payment, or the payback of that put option could be structured or somewhere.
Everything's negotiable. This one of the ones we did recently it was $120,000 loan, and right now it's interest only for 3 years. So they're paying them interest, like an 8 or 10% interest rate, which is a high interest rate for the next 3 years, and then it balloons, or that $120,000 is due. But that investor, for putting that $120,000 in, hopes to obviously get their $120,000 back plus their interest, but also got a 5% position in the company.
Kind of an expansion and a follow-up with are the put options somewhat like warrants on steroids, where it's a warrant but you're guaranteed?
Well, a warrant is an option to buy.
Right.
Yeah, so a put option is generally you own those shares through that period. So if something happens or whatever, you own those shares. A warrant is priced at and it could be today's price, right? But it's an option for you to buy. So you're still the investor still has to execute and write the check for the warrant. Let's say you've got 100 warrants at a buck, and 3 years from now the company sells for $3 a share or something like that. You now have that warrant to execute and buy those shares, or it'll accelerate vest at that dollar, and you're going to make $2 a share. But a warrant and an option are very, very similar, where they're just it's the opportunity to buy in the future at today's price. So a lot of investors will as well, when they either loan money or invest, they might invest and get equity, but they still want warrants as well. And it's just all it is giving them the future opportunity to buy in at that same price that they bought in today.
Is there a standard percentage of warrant protection? I've been talking to people and they're saying, well, we think about it at 25%.
Yeah, I've seen it as high as 30%. I like to keep it below 15%, but I've seen it as high as 30%, where somebody will put $200,000 in and still get 30% warrant coverage. And all that means is that 30% of that $200,000 divided by that today's price per share, and that's how many warrants they would get.
First of all, nice presentation.
Thank you.
What time horizon should one expect for the investor to expect you to big profit and then to get their payback?
Yeah.
And how does that vary by type of investment?
Yeah. Institutional or venture funds, they're now probably at a 5-year window. It used to be a 3 to 5 year window. I think it's probably more of a 5-year window. The angel investor is probably 5 to 7 as well. you know, it can change. Some angels will, again, they want the put option or whatever, but it's, you know, 3 to 7 years is probably a good range, but 5 is probably a good medium.
Kind of off back topic, when we were talking about sort of professional approval as far as patents and so forth, and when you're talking about funding, especially early stage, like a sort of a web-based idea, I think it can kind of see some direction early on, but if you're talking about, I'm kind of curious if you see a much different timeline when we're talking about drug development and medical device, things that require FDA approval or partnership with NIH. You know, the last statistic I saw was that process for one drug development cycle could be anywhere from 9 to 15 years in a price range of $15 to $30 million just to try and get to market.
And those are tough. There's no question about it. And it's finding the right investors. There are investors that are out there that like that, and it's finding, you know, specific industry people that like those risks. But it is a higher risk investment because of the validating points that have to occur for approval process.
JD, if you would just repeat the question, a lot of people can't.
Oh, I'm sorry. Anything else? Yeah.
What are you seeing right now in the current market as far as a good IRR for angel investor?
Good IRR for angel investing.
And what sort of things affect it?
Yeah, I mean, we actually like to see it above 25%. In other words, it's an annualized base that they're going to get on a return. We like to see it in that 25% rate. What affects it is two things: what the multiple at the exit's going to be, or what we think the business can be worth in a 5-year period. Normally, we'll look at it over a 5-year horizon. Sometimes it can be a 3-year horizon. But the two main things that affect it is the possibility of whether they have a put option or the calculation of what the business could be worth in 5 years if somebody came in and bought it or bought your shares out, et cetera. So it's that value plus the cash flow that they get during that period. So if the business is putting off $500,000 in free cash flow a year earnings, you know, after depreciation and everything, the business is putting off and they own 20% of that, they're getting those distributions as well. So that's a big piece of the IRR calculation as well, is the dividends and or distributions the business is putting off, plus the exit value.
Do investors look at your calculations for operating capital because it will affect the distributions?
Are you talking about the question about working capital requirements?
Right.
Absolutely. I mean, one of the more important things is use of funds. What do you need to get it? One of the bigger dangers is you're not capitalizing yourself enough, or you haven't thought through enough of what you need to get to a developmental stage or product stage. So absolutely, use of funds and how those funds are going to be possibly, you know, utilized for operational purposes, development purposes, expansion, and all of that. So it's very important, the use of fund side. Yeah.
You know, what's been the ratio in terms of, you know, investors that you've worked with that have hit sort of that, you know, the pretty much spot on or close to it in terms of, you know, the 5-year business plan in terms of the numbers that they're trying to reach, and, you know.
Well, I mean, I think, you know, it's probably over the last few years it's been a little less. In other words, they haven't hit the goals. You want me to repeat the question? What's been the results of investors with regard to the returns over the last 5 years, and have businesses sustain that? I think we're seeing a little bit, maybe with the economy and everything, lagging a little bit, and investors understanding that, and that's why it's been a little bit more challenging to get companies capitalized. But we've had some, and we've seen some, and obviously you've read about some that have done very, very well as well. And a lot of investors now are really specific on industry as well, and the industries they know, they understand, and the growth opportunities. But we've seen some do very, very well, and some continue to sustain. A lot of times, I don't have this percentage, but a great deal of times, they're going back for more capital that might not have been anticipated initially. You know, that's not always a bad thing, but they might be in a position where there's either further opportunities or the market didn't accept it, but there's still validation, there's still an opportunity there, so it might be that they're going for another round of capital that hadn't been anticipated.
And just to follow up on that, is more stock put into looking at the first 2 years of numbers or financials compared to the next 5 years? And I just say that in the sense of 5 years ago, no one ever thought that Apple would ever be the most valuable company in the world. I mean, it probably would have been a shock to most people. So
right. What are investors? You know, what are they weighting with regard to the financial the model, whether it's the 5th year or the 2nd year and all the way through is the question. There's no question there's more stress points put on the first couple of years, even in the first year. And that's back to making sure that you understand the metrics that are driving your business. And those metrics are, financial statements really are a reactionary look at your business. So it's really understanding that you understand whatever those key metrics are that drive the revenues or the expenditures of the company, and making sure that whatever those are, that you put those in the financial forecast and you can execute upon them. And so, if you will, the more stress testing is done, making sure you understand your model and you can get to a certain point, because a lot of times it's getting, whether it's getting to that, 500th customer or that $1 million of revenue, once you get to that point, then there's belief that you can get beyond that. So there's no question it's that early stage and the ability to get to the next level. Yeah.
How long do these deals take to broker or start? So let's say you have an idea and it's very dependent on the market and a quick window of opportunity. How long can some of these take to?
It could be up to 6 months.
Okay.
Yeah, I'm sorry. How long does it take? What's the normal funding stage timeline? It can be anywhere from 90 days, 3 months to 6 months, sometimes longer. I will tell you one thing. I meet with a lot of companies that have said they've been out in the marketplace 12 months, and they come in and you say, "What are you trying to do?" And they say, "Well, we're trying to raise $2 million," and I'm like, "Well, what do you have put together? What's your valuation and all of that?" "Well, we're leaving it up to the investor. Or it could be this way, or if they want it this way, it could be this way. If they want it this way," and my advice to them is, you haven't been raising money. We like to get people on offense versus defense. Here's the terms. Here's what we're trying to do. Here's how we're going to execute. Be able to articulate the business plan. So a lot of companies, it's a protracted process because they don't know what their ask is. They're having hypothetical theory conversations with potential investors and never really getting to the close of and articulating what they really want to occur. Yeah.
I was going to ask, what do you see more investors starting to come out of their turtle shell in the Des Moines area? I mean, with Ames seems to have a pretty strong venture and angel network, and Des Moines is kind of, I consider Des Moines kind of in an incubator stage still of trying to develop those angels. Do you see more of your clients starting to come to you and say, "Hey, we look for an opportunity for me," or are they still kind of, the stock market, the elections, are they still in the turtle shell, or are they starting to finally come out?
That's a really good question. What are we seeing with regard to particularly in the Des Moines market from the angel side as far as structure and organization and all that versus like Ames and Ames Seed and all of that? It's a great question. Yes, we do see more interested parties and deals. The difference in Des Moines right now is a lot of the clients we work with and a lot of the high net worth people that come to us generally like to do things individually. And the nice thing like Ames has done is they've got this Ames Seed Fund put together, Ames Seed Capital, where they're aggregating people and sources together. Des Moines hasn't quite got there yet. There's a lot of investors now up doing Ames Seed, and some do. I have a group of investors that, they have a lead individual, but he usually pulls 6 to 7 people together. He's got some structure around that. But in general, I do believe that we're seeing more interested people in alternative investments. What that percentage is, I couldn't tell you, but we're also seeing more people interested in actually acquiring businesses as well, and that's probably because more of retired executives, from some of the larger financial institutions in town as well. So. But more structure could be, put together with regard to the angel side of things here.
When you guys are structuring these deals, how is it that you get paid? Are you taking a consulting fee at the beginning? Or are you taking a piece of the action?
How does my firm get paid when we raise capital for a company? Generally, what we have 2 phases. We actually get paid hourly or consulting fee to get the book put together and get put a lot of things. If it's small enough, we'll just continue to get paid for our time. In other words, if it's less than $1 million raise, we generally just continue to be consultative to the process and all of that. If it's a large raise or a sell of a company, we get a transaction fee or success fee, and again, we're licensed to do that. And so we generally structured in really 2 phases, but the vast majority generally is on success.
Can You talked a little bit earlier about companies that are in the marketplace that aren't in the marketplace. They say they are, but they're not. And you talk about when they go to the investor and they're talking about valuations. And they're saying, well, if they want it this way, it's this way. If they want it this way. When you have a pre-revenue company, an early stage company who's trying to come up with a valuation and ask based upon an equity stake in a company, can you talk about the investor's viewpoint of the ask in relationship to the equity that's given based upon, like Mike's got his startup models and working on projected pro formas, but at some level the numbers are a little bit amorphous. You know, it's like nailing jello to a tree.
Right, right. I believe the question is how is it communicated to investors with regard to the value of the company, and how does that get determined on the initial investment? Is that the question?
Especially if it's a pre-revenue.
Yeah, on a pre-revenue company. It's negotiable, but my point, my prior comment, my point is if you don't at least have it clearly define what your initial ask is, you're really still not in that process. So what my point is, you might be raising money at a pre-revenue company and say, I think my business is worth $2 million and I'm trying to raise $500,000. They might come back and say, well, I tell you what, I can get a group of people, we can raise $500,000, but for that we want X% of your company versus this. And I see that happen all the time. But how you got them to that conversation was you told them you wanted $500 at $2 million valuation, or pre-money $2 million valuation. If you leave it hypothetical, it'll stay hypothetical. So the point is, it can be negotiated, but you got to get your ask. Yeah, and you got to be able to have that, structured in a simple term sheet. You don't have to have all, every term defined and everything else, but you really got to be on offense versus defense. And then it is negotiable.
What generally happens at that state when someone has a pre-revenue valuation, they're like, okay, $250,000 for a $2 million valuation. We see you put together some stuff here. Looks like you put some thought into it, but seriously.
Well, that's the part of it's the art of negotiating with them and making sure that they're an interested party as well. And if they truly are, it's looking at what else they could deliver to the company and all of that. And again, what I said prior is it's not just the financing. It's a strategic partner. Do they bring other value to the company and all of that? And it's a subjective process. There's no textbook on how to do that. And it's your gut feeling at the end of the day too. As long as you know that you're not in your heart giving up too much of your business, but and you can counter as well.
Thanks, Judy.
Yeah, thank you.